You may be better off smoking than investing in a 401k, says my man Dan McGrath from Jester Financial Technologies in an article he had written a few months back. And I've become a new fan of Dan's writing. This is a real good article, actually. We're going to talk about it, how your 401k plays into your Medicare increased premiums under IRMAA. We talked a little bit about IRMAA earlier today, and we're going to dive into it more as well, because I think it's a big deal, and I think a lot of people overlook that. So, as always, if you like what you see, subscribe down below. Don't forget to hit the thumbs up button as well to let the Google algorithm know, YouTube is Google, that you welcome and like this information on this content. That way Google says, hey, let's put this for other people to see. I appreciate that. Of course, subscribe and comments as well. So let's dive right into this. Again, a new fan of Jester Financial Technologies. They got that little Jester thing, kind of like a play probably of the Motley Fool. And Dan McGrath, you should put his picture up there. I don't know who this guy is, but I like his writing for sure. So his article is dated August 19th, 2018. You may be better off smoking than investing in a traditional IRA or a traditional 401k. It's not up for debate. Smoking is bad for you. It leads to cancer, harms every single organ in the body, and has become somewhat expensive as well. Somewhat. Jeez. I mean, a pack of cigarettes now costs what it used to cost for me when I was in the Army for a carton at the PX. You could buy a carton back in the day. This is like the late 80s, early 90s for like 10, 15 bucks at Newports. That's what I used to smoke. This is, again, late 80s, 90s. So a carton, 10, 15 bucks. I don't think in New York City you can buy a pack for less than 20. It's nuts. Obviously inflation too, but still, it's the taxes. Crazy. But when planning for retirement, you may, believe it or not, be better off smoking rather than investing in a traditional IRA or 401k. Sounds ridiculous, but with the understanding of federal regulations and your health coverage in retirement, it will become increasingly apparent that investing into any kind of tax-deferred investment is just really, really bad for you. The federal regs that you must know about are: you must enroll into Medicare to receive any Social Security benefit. This mandatory health coverage, Medicare, is based on your income through Medicare's IRMAA, the income-related monthly adjustment amount. The cost of this coverage is automatically deducted from your Social Security benefit. Income, by definition of the federal government, is your adjusted gross income plus any tax-exempt interest you may have on lines 37, and it's not 37 anymore, and 8B of your 1040. The lines have changed, and off the top of my head, I don't remember what they are, but they're not those same line numbers anymore, which is too bad because I knew those line items very, very well. I had them tattooed in this noggin up here, and now I'm going to have to get a guy to untattoo them and put new tattoos on there, and that's going to change in 2026. Some examples of income that counts towards IRMAA are Social Security benefits, wages, rental, pension income, interest, capital gains, dividends, and all distributions from any tax-deferred investments you may have, which includes your 401k and, of course, your IRA. Social Security benefits counts towards your IRMAA. Social Security benefits. How do they figure that? With a provisional income. And roughly, if 85% of your Social Security benefit is taxed, that will go into the modified adjusted gross income, which is used to figure out your IRMAA. And now it might be less. I mean, again, that's the benefit of a Roth IRA. You don't have to pay tax on your Social Security if you don't want. It's a matter of, do you want to pay a little bit tax now in terms of converting to a Roth to avoid big taxes in the future? By investing in that traditional 401k, you're setting yourself up for higher health costs as well as receiving a lower Social Security benefit. The tax benefits today of investing in a tax-deferred vehicle will be, if you live an average lifespan, negated thanks in part to Medicare's IRMAA. But will you be impacted by this? Thankfully, the federal government pegged the IRMAA brackets at a high level, which starts at $85,000 in income for a single person and $170,000 for a couple. So this shouldn't impact too many people. An example of who the federal government is eyeballing for Medicare's IRMAA, person A, he's 55 years old today and is going to retire at 70, is investing $10,000 a year in that traditional 401k with a 5% annual premium or return. Has saved $50,000 in that traditional IRA and earns $85,000 a year from employment. The good news is that by age 70, person A will have saved $40,000 in taxes by investing in the traditional 401k if they're in the 20% tax bracket, 25% tax bracket, which they certainly are not, because if they're A, there's no such thing as 25% tax bracket, and B, if they're earning $85,000, we'll just say they're single. Their AGI is 73,000, and we know that the first 9,000 is taxed at 10%. The next 30,000 roughly is taxed at 12, and the remainder above that, it's about another 40,000 or so, 35,000 is taxed at 22. So he won't save that much in taxes, but we'll just go with it. He will have saved 40,000 in taxes by investing in the traditional 401k. The nest egg will have grown to just over 350,000, and Social Security benefits, which he expects to grow at 2%, starts at 57,726. Unfortunately, there is bad news in the form of that mandatory health care coverage through Medicare. According to the Medicare Board of Trustees, Part B is expected to inflate by over 5.1% a year, while Part D is expected to inflate by 5.4% over the next 8 years. This means those IRMAA surcharge rates will inflate at the same rate too. Due to the required RMDs coupled with their Social Security benefit, they will enter Medicare's first IRMAA bracket at age 76 and remain there until age 81. Their Medicare Part D and B will be increased by about 40%, which will be automatically deducted from their Social Security. Person A should expect to pay roughly $15,750 in extra Medicare premiums, while also seeing their actually Social Security benefit being reduced by 14% annually. I'm telling you, it's nuts. At age 82, that guy will then enter the second IRMAA surcharge bracket. Remember, because it's the first one is just paying a 30% more premium. The next one is paying double premium for Medicare Part B and D. And the Medicare premiums will increase by about 100%, a doubling. Person A will remain in this bracket until age 85. The IRMAA surcharges in this period will total about $34,000, while the Social Security benefit will be lessened by as much as $23.8. But it gets worse because 86, this person will enter the third IRMAA surtax bracket where they remain until age 89. Now their Medicare premium will increase by 160%, totaling $66,500 in excess surcharges, and their Social Security benefit will fall by 35.5%. If person A does make it until age 90 and above, they will be in the fourth IRMAA bracket, and their Medicare Part B and D will be increased by 220%. And over the next 5 years, he'll be hit with $170,000 in surcharges, while seeing over 50% of their Social Security benefit being consumed by their Medicare premiums. Person A, throughout retirement, if they live until age 84, will never see any added benefit from their investment in a traditional IRA or 401k. All they will experience is increasing Medicare premiums and a dwindling Social Security benefit. They are truly better off either by smoking and dying early, or an even easier solution, investing in the Roth 401k of their employer plan. With a Roth, they'll never have to take a distribution. They'll never have any income count as income towards Medicare's IRMAA. Yes, they'll pay the extra $40,000 in taxes while working, but if they live until age 90, they'll save $142,000 in Medicare surcharges. The other benefit, they'll also keep another 25% for themselves for Social Security's benefit. All right, so that's a big deal. And then he go to Jester Financial and get Medicare, a practical guide to understanding your health care coverage in retirement. I haven't read it, but that'd be something for you to do for sure. Again, Jester Financial. Now, I'm not going to go all the specifics of these individual, the way he's looking at the taxes, the way he's looking at the surcharges. Frankly, it's way too in-depth because we just don't know. But I think that the point is very, very well made, as they're saying, if you have a decent income because of 401k and IRA distributions, that's going to affect you big time when it comes to your Medicare premiums. This seems a little bit high to me, frankly, because I'm not sure if he's using Social Security the way it's taxed. I don't know. I haven't seen the spreadsheet, what he's doing, but it still seems probably a little bit on the high end. Let's just say he's 50% too high. All right. So if he's 50% too high, we still have a couple. What's that? We still have 34,000, 17,000 more in Medicare surcharges, 8,000 more Medicare surcharges there, 33,000 more Medicare surcharges there, and that was at 85. I mean, we're still talking over $150,000 in Medicare surcharges, all for the pleasure of saving. Again, it's not 40,000 you're saving in taxes; it's probably 22,000. It just isn't worth it. Don't trade 22,000 tax savings now in order to pay 150, 100,000, but significant tens of thousands of dollars in increasing Medicare premiums in the future. It's nuts. And don't forget, This is a guy who's just 70 years old. He's got $350,000 in his 401k. That's it. We're not talking behemoth for a 401k plan. So, you may be better off smoking than investing in a traditional IRA because you want to die before the Medicare premiums kick in. It's crazy. So I thought it was a pretty good article. I'll leave this in the show notes. As always, you like what you see here, comment, questions, concerns, put them in the notes down there. And you could go online and get this guy's, I don't know if it's a book or Medicare, The Practical Guide to Understanding Healthcare Coverage and Retirement. It's probably worth a good read. So as always, don't forget, let me know what's going on in terms of what your situation is and put in the notes, and we'll see you guys next time. Thanks now.